What are the best months for stock market gains? This is a question that has been asked by investors for years. Many investors believe that stock markets perform better during certain times of the year. Is there any truth to these claims, or is it superstitious nonsense? Based on data gathered by Schroders and research from Visual Capitalist, we're going to find out. This data is based on 4 large stock indexes covering the past 31 years of performance. The first one is the S&P 500. It's an index of the 500 largest firms that trade on U.S. stock exchanges, ranked by market capitalization. Next is the MSCI World. This index has more than 1,000 large and mid-sized companies from developed countries. Third is the Eurostoxx 50. Within the Eurozone region, this is an index containing the top 50 blue-chip companies. And lastly, we have the FTSE 100. This is an index of the top 100 companies on the London Stock Exchange, ranked by market capitalization. The percentages in the table represent the historical frequency of these indexes, rising every month between 1987 and 2018. Months are ranked in descending sequence from best to worst. However, there are a few outliers in this data that we'll address shortly. In terms of stock growth, December has historically been the best month to own stocks. Many people believe that the stock market always goes up around Christmas. This belief is so widespread that there's even a name for it, the Santa Claus Rally. But is there any truth to this claim? Well, it turns out that the Santa Claus Rally is a real phenomenon. Stocks have tended to rise in the last week of December and the first 2 days of January. According to data compiled by Stock Traders Almanac, in the 70 years between 1950 and 2020, there have been 57 Santa Claus rallies, with an average gain of 1.3% for the S&P 500. And according to research from Schroders, in the month of December, there's a 79% chance that the stock market will rise in 4 of the most popular stock indexes. An example of a big Santa Claus rally occurred in December 2008, going into January 2009. The S&P 500 increased in value by 7.36% over a 7 trading day periods, starting December 24, 2008, and ending January 5, 2009. There are a number of theories as to why this happens, but it's hard to pinpoint the exact reasons. One theory is that it's caused by the completion of tax loss harvesting. Professional investors often adjust their portfolios at the end of the year in order to save money on taxes. They do this by selling stocks that have lost value in order to create a tax deduction that temporarily pushes down stock prices, but that trend is soon reversed as investors begin buying stocks again, pushing prices higher. There's also the theory that holiday shopping can bolster businesses' bottom lines and help boost stock prices. Also, many employees receive year-end bonuses that can be invested in the market. Regardless of the mechanics behind the rally, it's an observable effect, and it occurs roughly 2 out of 3 years. So, if you're thinking of investing in stocks this Christmas, you might want to consider buying into the Santa Claus rally. Just don't expect every year to be a winner. After all, even Santa has an off day now and then. The second best month is April, which is widely regarded as a strong month for the stock market. Many investors, according to one theory, receive their tax refunds in April and spend that money on stocks. The arrival of money into the stock market causes prices to rise as a result. Speaking of higher prices, we can also look at this trend from the perspective of returns. Looking at the S&P 500, since 1928, April has historically been a good month for investments. The average return over this time period is 0.88%, which is much higher than the average return of 0.47% for all months. According to this analysis, the 3 worst months to own stocks are June, August, and September. Do you think it is a coincidence that all of the worst months are in the summer? Another explanation for the season's sluggishness is that institutional traders are on vacation, as was the case in December. However, without the holiday spirit, the market is less frothy and liquidity is reduced, therefore increasing risk. The data, whether you believe it or not, shows a clear pattern. It's for this reason that the expression "sell in May and go away" has become so widespread. It's worth noting that this data is based on past history and should not be used as a predictor for future performance in the stock market. Anomalies such as the COVID-19 pandemic in 2020 may have a significant influence on the world, as well as the market as a whole. Stock market performance during these periods might differ dramatically from prior averages. So, what have we learned? The stock market Santa Claus rally is a real thing. It's been documented over many decades. And while there are some good months to own stocks, June isn't one of them. If you own stocks, April, October, and December might be your best bets.